Hi, this is Deepak Shenoy. Capitalmind Tube brings you what to vote. This is the Franklin Mutual Fund edition. If you might remember, about 6 months ago, April 23rd approximately, this was when Franklin Templeton said it's going to wind up 6 debt schemes because of extreme redemptions. And we'll talk about that. 6 funds on your screen. Many of them ultra short term to something that's longer term like income opportunities. Why did they choose to do this? They said, listen, we've got too many redemptions, we've got a lot of bonds. These bonds don't necessarily sell very easily. They own bonds of certain companies who nobody wants to buy the bonds of. And Franklin was one of the few companies that would buy bonds from these companies, effectively lending them money. And now nobody else wants to lend them money, so they had to go in for this winding up concept. They said no more fresh entries, no more redemptions. We're just going to wind it up and start giving money back according to when we receive it. Unfortunate problem, this went to SEBI, this went to courts, this went to Karnataka High Court, went to Supreme Court, and now they have a voting procedure going on to say, can we wind up these funds? They're asking all the investors. Everybody gets one vote. All investors get one vote. And given the way the structure is, unfortunately, you're going to have to vote. And you're going to have to vote yes or no to this winding up. Yes means let Franklin wind up, or Franklin or somebody else wind up the funds. What is a wind up? A wind up is essentially saying, listen, I have these bonds. I want to now give all this money back to shareholders. I'm going to try to find the best way to give it all back. So either I sell the bonds in the market if there's a market. If there isn't a market, I'll just wait till those bonds mature, or I'll talk to the company and say, listen, can you guys pay back in advance a little bit? Maybe something that will help a little bit earlier. And some of the companies will oblige, some will not. So the idea is, of course, try to do this in as meaningful a way as possible. That's the concept of winding up. It could be done by Franklin itself. It could be done by an external third party who works under certain parameters, saying try to maximize value for your unit holders. The second option is, no, don't wind up. Let's go back to business as usual. So start taking more fresh entries, take redemptions, work as usual. So I say I suggest you vote yes for the wind up. This will be something you actually have to do. You're going to get an email, or you might have already got one. And you should actually go to an online site and then press yes to allow them to wind up the fund. We'll go to that in a bit, but let's first look at what these funds are. And if you look at what these funds are today, they have assets. The largest is the ultra short bond fund, the smallest is the income opportunities fund. But roughly this is about 24,000 crores, 25,000 crores right now. But this will obviously, what has happened in the last 6 months is these assets that they had, the bonds, some of them start to pay out. So 4,738 crores is now the cash that's sitting in the ultra short bond fund, doing nothing. They can't even invest it in overnight paper right now. They're just sitting there. There's low duration, short-term income, credit risk. They all have various levels of cash. Income opportunities as negative cash. They've still borrowed money. What happened was they had all these bonds. Nobody wanted to buy them. So they were getting redemption. So they said, listen, instead of redeeming by trying to sell the bonds, let's go borrow some money. SEBI allows mutual funds to do that up to 10%. So they borrowed some money and then used that money to pay back people who are redeeming while keeping the bonds, saying, okay, when the bonds pay back, I'll pay back the bank and with the interest, and then there will be no need for me to stop redemptions. But when this got out of hand, they stopped it. So one of these funds continues to have this borrowing, about 230 odd crores, and the rest of them are holdings, bonds essentially. Now you can see here that most of the funds, or all the funds have almost very little AAA exposure. Everything is either AA or lower. Now that also means you are taking on risky exposure, but everybody knew that with Franklin. So, it's a very interesting concept because now you've got the risk of the mutual fund coming and hitting you on the face, and you've got a situation where a lot of these bonds which they hold are less than AA minus, which is A or lower. Ultra short bond has 22%, it's probably one of the lowest, and short term income fund has 73% in A or below securities. These are not necessarily bad. It's just that in Indian parlance, they're considered junk because India gives AAA to everything. So anything below AA is almost junk by definition. And I say junk, it doesn't mean that they'll default, it's just that people don't trust them as much. Okay. Look at the maturity profile at the bottom. Some of these, if you look at 31st December 2020, that means 47% of this fund will actually have full money back as of 31st December 2020. By April 2021, the same ultra short term bond fund will have 54% matured and redeemed, 82% by April 22, and so on. So you've got this including the current cash. That means if it already has 47% of cash, so 54 means another 7% will get matured and so on. This you can see the maturity profile over here, and you can see that, listen, some of these things, even if you wound up and even if you allowed an orderly wind up and there was no one to still buy those securities in the market, there's a very little small market for junk bonds in India. The low duration fund itself will take about 3 or 4 years to completely wind down and give you the money. So will the ultra short. Now, this does not mean that the funds are not getting interest, they're not getting paid out and all that stuff. If you look at the NAV from the time that this happened, April 23rd to now, some of these funds have returned more than 5 or 6%. So you got ultra short bond with all those assets giving you 5% just from April to now. So it's a fairly good return. Now, a good return is obviously bad, not so palatable. Bonds means great, higher risk, higher return kind of thing. So low duration fund itself has done 8% since April. This also means one thing. If you let the remaining run and 8% defaults, you'll still get the same NAV as April 23rd. That means if you consider April 23rd as, oh my God, this thing became NPA, bad loan and all that stuff, if you think of it that way, you'll get that money, whatever was owed to you on April 23rd, even if 8% of the fund defaults going forward. So it's a fairly good thing because that gives you that buffer. 2 funds are below, and that's because they've had some issues with credits that have taken in the fund. We'll talk about some of those interesting things as well. What should you do though as a unit holder? You should vote in favor, in our opinion, because winding up actually protects your value. Franklin is not going to operate these funds in normal circumstances. If you allow them to, people have lost trust. They will take out all their money. Now, the outcome, if you vote in favor of winding up, is you might get the entire value, or you might get maybe a little bit of a discount because they're going to have to sell bonds over time or liquidate them over time as soon as possible. So whatever decent discount they can get, they will take. If the votes are no, we expect a very high amount of redemption. That means people will rush to redeem and say, okay, you are allowing me to redeem, let me redeem. If they do that, the fund which has about 50% cash or 40% cash, it can pay out 40%, but if it gets more redemptions, it's going to have to try and sell those bonds. These low rated bonds have very little demand. They might have to sell it at a steep discount. So something that you think is worth 100 rupees, you might have to sell it 40 rupees. Or it might find that there is absolutely no demand for these securities because people feel that they don't want to take that risk at all. If you can't sell a security at all, maybe then you should mark it to zero. Not because you can't sell it, because the reason why people don't want to buy it is perhaps because they fear a default, and that could be because of COVID or multiple other reasons. But whatever it is, the AMC could mark them at zero. Now let's see why we're talking about all of this. What if they happens when you have redemptions, when you have so much cash, when you have somebody, let's take a fund with 100 investors, right? You've got 100 investors, the invested amount is 100 rupees each, assume, just as an assumption. You've got 10,000 rupees in this fund. Now let's say you've got cash of 30%, which is 3,000 rupees. Very good, 3,000 rupees cash, 7,000 rupees securities. But out of those securities, 7,000 crores, 7,000 rupees securities, you got 2,800 that are very illiquid, not good at all. So only 40%. That means if I have 7,000 crores worth of securities, only 2,800 crore are a little illiquid. You can't sell them. Nobody else wants them. People think they're a bad risk and so on. Now, if at this point I open up the fund because people have voted no, and they say, listen, we want 30% of us want our money back. You need to give back 30,000 rupees, You have 3,000 in cash, you could give all of that back. Instead, what if I said that, listen, if Franklin were to say, listen, I can't sell 2,800 crore worth of securities. I tried, I can't sell it. I'm going to mark that to zero. So the instant that happens, you are going to see an NAV drop from 100 rupees per unit to 72. So 2,800 out of 10,000 has become marked to zero forcibly because Franklin can't sell. So NAV comes down instantly to 72 from 100. And then people get paid back. And how much do they get paid back? If 30% say, listen, I want to take my money back. My NAV is now 72. So 72 into 30. So about 2,160 rupees is what I have to pay back. So use the cash paid back. The remaining 840 rupees remains as cash in the fund, and then the rest is the securities that I hold, of which of the 7,000 rupees, 2,800 are bad, illiquid, or not palatable to the environment. Same thing with 40 and 50%. But let's assume you paid back. There are other people who remain. I said only 30% have asked for redemptions. The remaining 70%, what happens to them? Now they also own units, and those units are at 72 rupees per unit. Now this means that I have 70 investors left, and I have 72 units, 7,000, 7,800, and sorry, yes, you've brought the NAV down to 72, just to say that. Now what this also means is that when, let us say, the remaining bonds pay out, they will pay out the full 7,000. So what will happen is, I will now have 7,840 rupees in the fund, and I have only 70 unit holders. So if you consider that for 70 unit holders, I am worth 7,840, that's roughly 110 rupees or 111 rupees per unit. So what was 100 rupees per unit today will, for the remaining unit holders, become 7,800 rupees. So your 100 rupees will become 110 rupees. Whereas if you redeemed, you got only 72 because they marked the illiquid securities down to zero. Now, in a conference call, we asked this question, and Franklin's team told us that they don't think that is possible just like that, because you may not be able to get out or push the securities to zero. They might have to take a haircut, a discount, offer it in a much lower value, but I don't think they'll be able to take it out to zero. So they don't think that's possible, but I think some of them, they will have to do it. They absolutely can't do anything else. There's a reason. If you assign it even 1 rupee of a value, then everybody who's redeeming gets that 1 rupee of value correspondingly, right? Because I am going to assume the NAV is 100 rupees. If you tell me it's 101, I will redeem and I will get 101. You have to find that 101 from somewhere. So I believe that it may still be likely, although they're saying that it's not likely, it may still be likely if there are a lot of refunds, a lot of redemptions, they will mark down some of the securities to zero, and this will cause the funds to reduce their, will cause their funds to reduce their NAV on a per unit basis when you redeem, and only if you stay with the fund for a while is when you'll get the full value. This is one of the reasons why we are saying don't do it. There's a couple of other reasons as well, but what happens now is the potential risks as well. So if you say wind up, whether you say it or not, some of the funds have exposure to Shapurji Pallonji, who has defaulted to a bank, not to Franklin yet, but to a bank. Now, this is not a huge amount, it's about 500 crores or so, but this risk is that if Shapurji defaulted to a bank, why can't it default to Franklin as well? So, and the maximum exposure is 5.5% in income opportunities, which means that that fund, if there is a default, could see another hit of 5.5%. These are not marked down at all. So, if that risk, that there's a potential risk that could happen, and this can happen regardless of winding up or not. But if you do choose to wind up, it could hit the fund, whereas now there is a small potential chance they could try to sell these securities at a very steep discount. If you vote no, they will have to try and sell it, and since if there's no buyer, they'll have to mark it down or so. So this is the risk that's there. There's a kicker as well. There are certain funds which have exposure to future group, that is short-term income, and a couple of others, as you can see. Due to the past default of these bonds, they've been marked down to zero already. So if you stay, and if the Reliance future deal goes through, which could take till the middle or end of next year, we believe that because these are the promoters of the future group who have this exposure, and they will get some money and they will be able to pay back their investors. This money could come back, and again, it's a small percentage, so it may not be a huge thing, but there is a kicker over here. Now, what this actually means is that you should vote yes to winding up. These kickers and risks are fine, but one of the reasons why you should vote yes is simply that your voting will impact the way the entire fund behaves. Now, the fund's behavior is related to how Franklin is allowed to act. It cannot charge any management fees. It has no desire to add more money into this fund, so it's not going to open fresh entries. Nobody will want to invest anyways, but they're not going to allow it. Even if you say allow redemptions, they're not going to allow fresh entries. That's my take on this. Another point over here is that they have a bunch of securities which mature 2028, 2029, but some of those securities have an inbuilt assessment of risk. Now, I'm going to quickly go to Franklin's website and show you exactly what I mean by this. And this is, if you look at the website that they actually have the notice for e-voting. You're going to click here and you can put your, put your specific, look at the notices that you have. Look at each of these FAQs and what they're talking about. They're also taking the same thing we are. But for them, it's just easier for them to wind up than to run the funds going forward, because no matter what happens, those funds are not going to survive. People are going to take out money as soon as they can, I think at least. And it may, while it may not make a great amount of difference to you if you're not an investor, this does create issues. So given this, there's a bunch of notices, and this notice was sent on for each fund. It's separate. So if you're a unit holder in multiple funds, you have to vote for every single fund. You also need to they're talking about each of these funds. Why is this fund winding up, and how you can go in. You can go to evoting.kfintech.com, log in with a password connected to your email ID. I mean, it's not your email ID, it's your folio. And you have to do this for every single fund that you own that is a part of this Franklin set. This is open from December 26th to December 28th. So it's in 2 days only, and this is in the Christmas holidays. So if you have a lot of Franklin funds, you're going to have to take out time in those holidays to vote. But this is also because you need a 20-day notice or something before you actually commence voting. So this is by law a certain amount of time that's required, and this is not the end vote. After this, it could go to another vote, and then again it could go to Supreme Court on appeal in a different way, in a different kind of this thing. So the litigation will still mean that you don't get your money before maybe mid to end next year, but at least now there's some visibility that you'll get your money back. Now if you look here at the updates, and I'll go to downloads and then click on updates, this will actually show you what each of these securities owns. So to give you an example, I will look at, for instance, the maturity profile of the security level portfolio. So if I looked at the security level portfolio, I can show you that there is a bunch of things here that people will be able to buy, like a PNB Housing Finance. I'm sure it's going to mature on 15 December 2020. So that's about 100 crores. It'll come back. But there are some like UP Power Corporation, which is again Jan 2021. It's not going to sell very easily, but then it's Jan 2021. This Bharti Telecom, that's fine. The issue comes into things where you suddenly don't understand what the underlying is, which is like Xanda Finance, perhaps Clicks Capital. It's not going at the most brilliant of values. Shriram Transport, which currently trades at 10% plus in the secondary market. And there are a few others. There's Northern Arc Capital, there's Talwandi Sabo. These are all infrastructure projects. Sika is fine because it's Reliance. That's not going to have hurt. But Talwandi Sabo is actually Vedanta, where again Vedanta bonds are trading at 10 to 11% in the market. So a subsidiary of Vedanta is unlikely to get a huge amount of valuation. So there's a lot of bonds out there that may not sell. So we believe here, of course, that you've got a little bit of, so you can look at the group-wise exposure. They've got groups like Indostar, Clicks, Edelweiss, all of which appear, at least other than Indostar maybe, there's some level of stress that appears, and therefore there's not much of a demand. If there was a big junk bond market in India, you would actually find prices for this. So if it's even 50 rupees, 50 paisa to a rupee, they could sell at a 50% discount and give you back your money. But right now, it's almost like saying, listen, nobody wants to buy it at any price. So it's perhaps that part of the market, a more actively traded junk market. And junk also has a problem because people say, listen, I don't want to sell at a 50% discount. Now, what kind of nonsense is that if you're not willing to sell at a discount when you have to, and then you blame the market? That's not going to work, because there'll always be a buyer. There could be a buyer at a much lower price, which you're not willing to sell for whatever your own reasons. And people just take outrage for no reason at all, because they think they're God-given right to higher NAVs. But that's the way the market is. When things are in trouble, things are in stress, you got to take a haircut and move on. If moving on is not important, then why are we even here? So if you look at these portfolios, you'll actually find that a bunch of things are happening here. Now, I'm not going to defend Franklin for buying these bonds or for owning them. But let me just say that, listen, if you're a Franklin investor and you thought that somebody was showering flowery petals on you for the last 10 years by giving you a 2% extra return on the same bonds that where other mutual funds are holding similar duration funds and giving you 7%, Franklin was giving you 9%. It wasn't because they were, they were getting some kind of extra amount from nowhere. It was because they were taking these kinds of risks, and that's why these bonds trade at these high levels, is because very few people apart from Franklin were willing to invest in these bonds in the first place. So it's not like these are very bad companies. There's Renew Power, there is Shriram Transport, there is Clicks Capital. These are companies that may not go bust in the end, but people don't want to take the risk on some of those bonds anymore. This you can see this on a bi-weekly basis. I think Franklin announces this. What I believe you might end up doing, and you're looking at this saying, listen, should we wind it up, should we not? If you don't, my belief is Franklin's going to mark down a substantial portion of these bonds, maybe 30 or 40%, and that will give you a much lower NAV. And although you've made 8% in the last, or 5 to 8% in the last 6 or 7 months, you lose more because the NAV will be written down at a much higher level if you vote no, if enough people vote no. Now, one person, one vote, because you're part of a trust. So you, with your 10,000 rupees, will probably have the same voting power as an institution that has 2,000 crores, because it's not 1 crore, 1 vote. It is 1 person, 1 vote, apparently. So the number of shareholders matters. There are no unit holders matters, and there are no new unit holders, right? Because they stopped new subscriptions in April. So if you weren't a unit holder, then you can't become one now. And therefore, my call is, yes, you have to go, you have to vote, you have to and vote by your choice. But I would say vote yes. Let this wind up. Let the funds shut. Maybe don't invest in bonds like Franklin again if you're not cognizant of the risk. But more importantly, let this wind down, because you don't really have an option, because the funds can't continue. The minute they are allowed to continue, they will see redemptions. Almost all the people will redeem, and the funds will naturally have to shut down. So regardless of what you do, the funds are going out. That's my view of this whole thing. And of course, think about the one thing that matters to you is just getting as much of your money back as quickly as possible, without it being too dramatic a damage. So if you're if you look at the maturity profile of, say, ultra short bond fund, if you're an investor there, you probably are, because that's got most number of investors. In a year or so maybe a year and a half, by 30th April 2022, you'll have 82% of your money back if everybody pays, and if everybody pays their interest as well, possibly 100% of what was available in 2020, April 23rd, 2020 is what will come back to you. So you'll get all your money back in about 1.5 years from now if you choose to allow to wind up. If you don't, you might see a smaller amount, maybe 50 or 60%. If what's important to you is get me even 50, 60, I'm fine, then yeah, vote no. I mean, then it's fine. That's your call. But if you want think about it. Okay, if I gave you 50 rupees now versus giving you 100 rupees 1.5 years from now, would you take it? Which one would you take? I mean, if you say 50 rupees now versus 100 rupees 1.5 years later, the choice is like this: take 50 rupees now, put it somewhere else, and let that somewhere else grow it to 100 rupees in 1.5 years. If you find such an opportunity, let me know, especially in bonds, because and I'd love to participate as well. But the point is, it's now not 100%. Let's say even 70%. 50 versus 70 is still a steal in these times when your interest rates are next to what 3.5%, 4% in liquids and in safe instruments. So I would say vote yes. This is just my choice, and we at Capital Mind have been following this from the beginning, and we think that at this point, you have to forget the past and go on to the future. Whatever happened. What's best now is what needs to happen going forward. All the best and thanks for listening.